What if one of the most important economic shifts of our time is already underway, but hasn't fully appeared in the data yet? What if the numbers we follow every day don't tell the complete story? And what if certain market movements, timed with striking precision, are raising deeper questions about how information flows through the global financial system? Over the past several weeks, analysts and market observers have noticed unusual patterns in the oil market: large scale trading activity, precise timing around major public statements, and a widening gap between financial prices and real world costs. Individually, each of these signals may have reasonable explanations, but together they point to something worth examining more closely. Tonight, we're going to follow the data step by step. Not speculation, not assumptions, just verifiable patterns, historical context, and expert perspectives to better understand what may be developing beneath the surface of the global economy. There is a moment in many economic cycles when early signals appear, but their full meaning isn't yet widely understood. Some analysts believe we may be in such a moment now, particularly in global energy markets. Oil plays a foundational role in the modern economy. It powers transportation, supports manufacturing, and underpins supply chains that connect nearly every sector. Because of this, even subtle shifts in oil markets can ripple outward, affecting inflation, growth, and global stability. Recently, market participants have observed an increase in large trading positions placed shortly before major public announcements related to economic or geopolitical developments. It's important to note, timing alone does not imply wrongdoing. Financial markets are complex, and institutional investors often act based on models, forecasts, and publicly available information. However, when patterns repeat, analysts naturally begin to ask questions. How do expectations form in global markets? Who reacts first and why? And how does timing influence price movement? To understand this, we need to explore a key concept: the difference between financial pricing and physical supply. In oil markets, there are effectively two parallel systems. The first is the financial market, where oil is traded through futures contracts and benchmarks such as Brent crude. This is often referred to as the paper market. The second is the physical market, where actual barrels of oil are produced, transported, and delivered. Historically, these two systems move closely together, but at times they can diverge. Recent reports suggest that this gap has widened in certain regions, with physical supply conditions tightening while financial prices show more moderate movement. There are several possible explanations for this. Financial markets tend to be forward-looking, meaning prices often reflect expectations about future supply and demand rather than current conditions alone. At the same time, logistical constraints, such as shipping delays or regional disruptions, can temporarily affect physical availability without immediately impacting global benchmarks. Another factor is market structure. When investors take positions expecting prices to decline, it can create downward pressure in the short term. This is a normal part of how markets function. However, if expectations shift rapidly, particularly in a tight supply environment, prices can adjust quickly in the opposite direction. This dynamic has been observed in past cycles and is sometimes referred to as a short squeeze, where rapid buying occurs as traders adjust positions. Beyond trading activity, geography also plays a critical role. A significant portion of the world's oil supply moves through key maritime routes. These routes are essential for maintaining steady global flows. When uncertainty arises, whether due to logistical issues, regional tensions, or policy changes, markets respond. Sometimes immediately, sometimes gradually. In recent months, reports have highlighted periods of increased uncertainty affecting certain shipping routes. While global supply has continued to flow, even temporary disruptions can influence expectations and pricing behavior. And in markets driven by both data and sentiment, expectations matter very much. At the same time, broader economic indicators are also shifting. Institutions such as the International Monetary Fund have noted that sustained energy volatility can contribute to inflationary pressure while also slowing economic growth. This combination, often referred to as stagflation, is challenging for policymakers. It requires balancing price stability with economic expansion, a task that becomes more complex when external variables like energy costs remain uncertain. Different regions are experiencing these pressures in different ways. Energy importing economies in parts of Asia and Europe have focused on diversification strategies and efficiency measures. In developing regions, even modest changes in fuel costs can have a more immediate impact on daily life. And in the United States, while domestic production plays a significant role, the country remains connected to global markets. That means international developments still influence domestic pricing, supply chains, and economic conditions. Another area worth watching is the bond market. Rising yields in several major economies suggest shifting expectations about inflation and interest rates. Higher borrowing costs can affect both governments and businesses, adding another layer of complexity to an already evolving environment. When you step back and look at all these elements together, energy markets, financial positioning, supply chains, and macroeconomic signals, a broader picture begins to emerge, not necessarily of a crisis, but of a system under pressure. And in such environments, perception becomes just as important as reality. Markets rely on trust in data, trust in transparency, trust in the idea that prices reflect underlying conditions. When questions arise about any of these elements, even indirectly, it can influence behavior. Investors become more cautious, institutions adjust strategies, and volatility can increase. History provides useful context here. During past energy disruptions, markets did not always immediately reflect the full scale of underlying challenges. Adjustments often occurred in stages, sometimes gradually, sometimes suddenly. However, every period is different. Today's global economy is more interconnected than ever. Financial systems are faster, information travels instantly, and responses, both policy driven and market based, can unfold at a much quicker pace. That can be a stabilizing force, but it can also amplify movements when shifts occur. So, where does that leave us now? Some analysts view current market behavior as a natural adjustment process. Others see it as a sign of deeper structural stress, and many take a cautious, data driven approach, watching how these patterns evolve over time. Because ultimately, markets tend to reconcile differences between expectation and reality, not always immediately, but consistently over the long term. Public discussion around these developments reflects a wide range of perspectives. Some observers emphasize the role of expectations, noting that markets often price in future improvements before they fully materialize. Others focus on physical supply dynamics, pointing out that real world constraints eventually influence financial pricing. And some highlight the importance of transparency and timing, suggesting that understanding how information flows is key to interpreting market behavior. Each of these perspectives contributes to a broader conversation, one that underscores how complex and interconnected global markets have become. The global economy is not defined by a single indicator. It's shaped by a network of signals, some visible, others more subtle. Right now, the oil market is offering a set of signals that analysts are watching closely, not as definitive answers, but as early indicators of potential change. Whether these patterns resolve smoothly or evolve into something more significant remains to be seen. What is clear, however, is that understanding these dynamics matters because energy, markets, and information are deeply connected. And when those connections shift, the effects can reach far beyond any single sector. Thank you for watching. If you found this analysis helpful, consider subscribing for more in-depth, data-driven insights. Stay informed, stay curious, and we'll see you in the next one.